Hello everyone, this is Ankit from Sastra BTech, final year ECE. Uh, I am here going to explain about the caste and its types. In this presentation, we will discuss about the types of caste. Caste. In general, caste refers to the amount of resource typically measured in monetary terms that are required to produce or obtain goods or services. It is an essential concept in economics and business as it represents the sacrifice or trade-off involved in acquiring something. There are different types of caste. These are the different types of caste. Let us discuss about opportunity cost and actual cost. Opportunity cost and actual cost are two important concepts in economics that are often used to make decisions about the best use of resources. Let me explain these concepts in more detail. Opportunity cost refers to the cost for going the next best alternative which making a decision. This means that when you choose to do one thing, you are giving up the opportunity to do something else. For example, if you choose to attend a seminar, the opportunity cost is the cost of not using that time to do something else that you value, such as working on a project or spending time with family. On the other hand, actual cost, on the other hand, refers to the actual monetary cost of the decision or an action. This can include direct costs such as the cost of purchasing a ticket to the seminar, as well as indirect costs such as the cost of transportation or the cost of taking time off work to attend the seminar. Now let us see about explicit and implicit cost. Explicit cost or the cost that a business incurs as a result of its operations and can be easily identified and quantified. These costs include expenses such as rent, utilities, wages, and the cost of raw materials. Explicit cost or expenses that a business pays out of pocket, and they can be deducted from the business taxable income. For example, if a business spends 10,000 on rent, that 10,000 is an explicit cost. On the other hand, implicit cost or cost that are not directly visible or incurred by the business but still affect the business operations and decision making. These costs are opportunity costs on the cost of foregoing alternative opportunities when making a decision. For example, if a business owner decides to quit their job to start a business, the foregone income from their job is an implicit cost. Another example of implicit cost is the use of a company-owned building for a business opportunities instead of renting it out to the third party. Let us discuss about direct and indirect cost. Direct cost refers to expenses that are directly related to the production of goods or services. These costs can be easily tracked to specify product or service and can include things like the cost of materials, labor, and equipment. For example, in a manufacturing company, the direct cost could include the cost of raw materials, wages, and the cost of operating machinery. On the other hand, indirect costs are expenses that are not directly related to the production of goods or services but still necessary for the business to operate. For example, In the same manufacturing company, the indirect costs would include things like rent paid for the factory building, utilities such as electricity and water, and salaries paid to administrative staff. Here comes the historical cost and replacement cost. These are the two different methods used in accounting value assets. Historical cost refers to the original cost of acquiring an asset. This is the amount that was paid for the asset when it was first purchased or acquired. This cost is recorded on the balance sheet and is used to determine the value of the asset over time. For example, if a company purchased a building for 1 million, this would be historical cost of the building and would be recorded as such on the balance sheet. Replacement cost, on the other hand, is the replacement cost, the cost of replacing an asset with a new one that has the same or similar function. This is the amount that would need to be spent to replace the asset as its current value. This method is often used to value assets that are subject to significant price fluctuations, such as commodities or marketable securities. For example, if a company owns a fleet or trucks that are now outdated and need to be replaced, the replacement cost of the fleet would be the amount it could cost to purchase new trucks with similar capabilities. Next, fixed and variable cost. Fixed costs are costs that are change with changes in the level of production of sales. These costs are usually incurred regardless of the volume of input production by a business. For example, fixed costs include rent, insurance, property, tax, and salaries of permanent staff. Fixed costs are also known as overhead cost or indirect cost. Variable cost, on the other hand, are costs that change with changes in the level of production or sales. These costs vary in proportion to the volume of output produced by a business. Example of variable cost include direct labor, raw materials, production supplies, and utilities. Variable cost are also known as direct cost, fixed cost, and variable cost. Here I give the graph for your reference. The total cost is an important metric as it helps a company determine the probabilities of its operation. In conclusion, understanding the different types of cost is effective in managing the expenses and making profit in all business. Thank you.